We are in Chapter 5, Working Capital Management. In our last class, we have completed or we discussed working capital and its importance. And today, we will discuss planning and control of cash and marketable securities, debtors, current liabilities, and stock. Planning and control of cash planning and cash management. Tools are generally used to control cash position, cash generation, and cash conversion cycle. Planning and control of marketable securities, designing the marketable securities, planning and control of debtors, determination of inventory, accounts receivable, planning control current liabilities, the stock, ratio associated with the working capital management, and we'll solve few problems regarding working capital management. So working capital management, your exam is a vital point, and that means within this chapter we'll get one question definitely. Planning and control and cash and marketable security. If we see planning and control of cash, we know the cash flow is a forecast or cash flow management is a key aspect of financial management of a business. Planning its future cash requirement to avoid a crisis of liquidity. So main thing is that to avoid a crisis of liquidity, so cash management is very much important. Planning of cash. Cash flow forecast is important because if a business run out of a cash and it is not able to obtain new finance, it will become insolvent. Cash management is a concern with the managing of cash flow in and out of a firm, cash flow within the firm, cash balance held by the firm at a point of time by finance that was involving surplus cash, etc. So it also seek to achieve liquidity and control. If it is significant, because it is used to pay the firm's obligation. Basically, your short-term obligation we can solve from the positive working capital. So, cash planning is a technique to plan and control the use of cash. It helps to anticipate the future cash flow and need of the firm and reduce the possibility of idle cash balance as cash defects. Cash planning may be done by daily, weekly, or monthly, yearly. So based on the organization pattern, based on the organization nature, cash planning can be daily, can be weekly, can be monthly. Generally, we are doing a few companies are cash planning for the quarterly also. So it is depend on the size of the company and philosophy of the management. Look here, first have to forecast the sale, and from there we prepare income statement, the plan or budgeted income statement, and based on that income statement also we are from the balance sheet, budgeted balance sheet. So what amount we need for the next period of time that have to calculate for the cash budget and cash flow, and this is the future cash flow. And in accounting we are preparing cash flow as per International Accounting Standard 7, but that cash flow is the post cash flow because it's the part of the financial statement. It is also the forecast cash flow. Based on the forecast cash flow, fund have to arrange for the company because for meeting the obligation. And cash management cycle we can describe this way: business operation if we do, and within this business operation it can be cash collection or cash payment, and it is the cash management cycle. And here sometimes cash can be surplus, can be defect, and if defects, that means short of the cash, then have to borrow. That means we have to find out the fund from other source, banks or other institute or other way. If surplus cash, then we have to invest this in the proper way, because all have the fund cost. Cash control within the organization have to fix responsibility within the organization. Someone or some department should take care of that, and segregation of duty have to need to the control also. For example, if there are a lot of people who are working in bank, the bank is the custodian, and also all banks have the vault for keeping the money. That vault key keeping 2 or 3 person, not a single person. So this is also control, and segregation of duty should be written from, and documentation of procedure, and physical control, independent internal verification, human resource control. This is the main point for the control, and following tools are generally used for control of the cash position. Cash budget report. So cash budget report is also a good tool for cash control. For this purpose, a cash budget report is prepared as a supplement of cash budget. It presents a comparison between actual budget and cash received payment, etc. So here, inflow and outflow cash should be managed and should be recorded and in order to check the cash position, a cash flow statement is prepared. It helps controlling inflow and outflow of cash. And if you see in a bank's regular balancing, and also how much money they are keeping in the vault, the number of note, that means how many notes are 1,000 taka, how many notes are 500 takas, how many notes are 100 takas, etc. All can be write down within the ledger, and that is the control of cash. That means also sometimes we can control through the ratio analysis. Cash ratio are also important tools for cash control. Various cash ratio are used for explain the efficiency and for the cash management. And this ratio are sometimes we are using current ratio, quick ratio, or asset test ratio, receivable turnover, inventories, investors turnover ratio, cash position ratio, etc. ratio can be used for cash control. Cash generation and disposition process describing here, and there are some regular cash inflow, some are irregular. Regular is come from the operational side, and irregular some for example some are one time, some are frequent after 1 year. That means for example, if you sell in bond or share, etc., is the irregular cash inflow. It's come in the cash flow. And also our sale from the operation is come as a regular cash flow. And some are irregular outflow, some are regular outflow. Regular outflow, that means we are paying the creditors' bills, others' expenses, etc. for the operation is the regular outflow. Irregular outflow means dividend, and it can be happened or not. If profit, then dividend is a yearly one time. And also with the interest, for example, if we bring or borrow money from the bank, we have to pay the interest, and that can be quarterly or installment base or yearly, etc. And also share repurchase, though we are not allowed in Bangladesh, and the company cannot buy its own share. And also tax, it is the irregular cash outflow, because we will pay the tax, that is advance tax, quarterly or yearly, etc. So it is the irregular. So look here, is the irregular inflow is the irregular outflow. So here within the cash balance, from this cash we purchase marketable securities for the investment, and also if we sell, that cash will come in the cash balance. Again, from this cash, we are purchasing fixed asset. We are paying the labor or material expense. That means you are paying for the creditors. At that amount, inventories. From the inventory, we sell, that means finished goods inventory. If we sell from the cash sale, that cash also come to the cash balance. And if we sell in the credit, that means credit sale, will increase the receivable within the organization. And from the collection of the receivable, that amounts also go to the cash balance. And also fixed asset, if we sell, then that cash also in the cash balance. So this is the cash generation and disposition process we are describing. Cash conversion cycle. So the cash conversion cycle, which represent interaction between the component of working capital and the flow of cash within a company, can be used to determine the amount of cash needed for any sale level. Here, if it is a period of time between the outlet, for example, look here operating cycle, this full cycle is operating cycle. Here inventory days, receivable days, payable days, and cash conversion cycle within the here inventory. How many days we are keeping the inventories, and how many days, that means receivable, that means we are getting money from the debtors, how many days, and within the cycle, how many days we have to pay to our payables or creditors. That means that inventory, receivable, and minus the payable days, then the cycle, the remaining one is cash conversion cycle. The longer of cash conversion cycle, the greater the amount of investment required in working capital. So that conversion cycle is longer, then we have to keep money within for the working capital as an, for example, debtors or receivable, etc. The length of cash conversion cycle depends on the length of inventory conversion period, trade receivable collection period, and trade payable deferral period. Cash conversion cycle depend on here three items: inventory conversion period, trade receivable collection period, and payable deferral period. So inventory conversion period is the average time taken to the use of raw material plus the average time taken to convert raw material into finished goods plus the average time taken to sell finished goods to customer. So it is the inventory conversion period. And trade receivable, same way, it is the average time taken to the credit customers sell their account, and trade payable deferral period, etc. So here we can say cash conversion cycle CCC equal to inventory days plus trade receivable days minus trade payable days. Cash conversion cycle DIH plus DOS minus DPO. So DIS, days inventory held, we can calculate inventory divided by cost of goods sold multiplied by 360 days or 65 days, that means 1 year. And same way, days sale outstanding, DSO, accounts receivable divided by revenue multiplied by 360 days. And same way, DPO, days payable outstanding, accounts payable divided by cost of goods sold multiplied by 365 or 60 days. So this way, cash conversion cycle we can calculate. Planning and control of marketable securities is also a very liquid security that can convert into the cash quickly at a reasonable price. And marketable securities, the securities or debt that are to be sold or redeemed within a year. These are the financial instrument that can be easily converted to the cash, as the government bond and Bangladesh Bank treasury bill, treasury bond, and common stock or certificate, etc. Marketable security include commercial paper, banks' acceptance, treasury bill, and other money market instrument is the marketable securities. So here is a chart of marketable securities. Few things not for our country, it's for another countries, but the structure is here. So marketable security, capital market security, derivative, and indirect investment. There are marketable security, a treasury bond, a US dollar bond, commercial paper, negotiable certificate, banks acceptance, etc. And capital market, common stock, equity share, capital market securities in here, common share, and bond, corporate bond, etc. And also derivative. Then in our country, there is that type of instrument not here at this moment. I think in future, that type of instrument not in our capital market also. Derivative, that is future option, etc. But we are hoping that in future that type of instrument will come in our capital market. That type also marketable security, and marketable that means liquidity, the ability to sell a significant volume of securities as a short period of time is the secondary market with a significant price concession. And also, recently Securities and Exchange Commission given a directive that all perpetual bond, the banks who have arranged for perpetual bond and collect the money after closing the collection, that is within 30 days, they have to go for the listing. And that means secondary market also is coming on, and we are hoping this way, day by day, our capital market will be vibrant. And so here investment are held either for profit or control purpose. It held for profit. The current market value provides useful information on the profit potential. Also, that means marketable and liquidity. When we need the money, we can sell it to the market and take the money for use purpose. Decision, security portfolio, planning and control of debtors. Debt planning and control of debtors. Debtor is also a component of working capital. So a debtor is an entity that owes a debt to another entity. The entity may be an individual, a company, or government or entity, a company or other legal person. So the counterpart is called a creditor. When the counterpart of these debt arrangements is a bank, the debtor is often deferred as a borrower. So sometimes control of debtor we can control this way, can be fixed credit limit, prompt recording, prompt adjustment, aging-wise scheduling, a statement of account manage, discount and write-off arrangement, and reconcile control account. This way can be managed, and managing debtors is one of the key advantages of the offering credit to customers is an increase in sale. That means if we offer credit, the sale will be increased, and credit is often used as a competitive marketing advice to attract new customers also. Against the increasing sale must be set the cost of offering credit. So that's why we have to calculate how much and how many days we may offer the credit to our customer. So increase investment in debtors and reduce cash flow to the firm. That means increase investment in debtors, reduce the cash flow of the firm, and increase the bad debt also. It makes some size loss. Accounts receivable process, we can say here accounts receivable process. So invoice or statement sent to the payment received. If yes, then full payment. If yes, investment, that means a fully paid. If no, then accounts overdue. First, That means we will give you the requisition for giving the money, and second time also, and final demand we can give to our customer. If accounts overdue, no, then full payment, then invoice settlement. So this is the flow chart of accounts receivable process, either within the system or any accounting software system. This is the flow chart of accounts receivable process. Keep a close grip, that means eye to existing customer, especially if trading patterns suddenly change. It can be an indication the business financial position also. That type of problem is sometimes happening. Keep a close eye on existing customer, especially if trading pattern suddenly change. It could be an indication that the business is hitting financial problem, in which case will be needed to take action to reduce your company's exposure. So this is the basic thing here for controlling the receivable management and determining the investment in accounts receivable. Now, how much money you will invest in your accounts receivable, because accounts receivable also a part of working capital. So here, percent of credit sale to total sale is this. If we think this bigger, credit and collection period, level of sale, that level of credit sale that goes to investment in accounts receivable, that is involved in the money. So credit here need the terms of sale, types of customer, collection effort, etc. Its length of time before credit sale are collected. So if give some emphasis for collection the money and the terms and condition of favor of the company, that would be held for collect the money, that amount in investment accounts receivable. Planning and control of liability. So current liability, the company's debts or obligation that are due within 1 year. So we know current liability is also part of working capital, as like current asset. That means one is a current asset, another is current liability. So liability is an obligation. So appearing the company's balance sheet in including short-term debt, accounts receivable, accrued liability, and other debts, payable also. So essentially, these are bills that are due to creditors and suppliers within a short period of time. If we see in our balance sheet, and that the part of liability is that means we know total asset equal to total liability and owner's equity, and within a liability it's the fixed liability and current liability. So fixed liability is that, and current liability is Sunday creditor, bills payable, outstanding expense, etc. The part of working capital is the current liability. So current liability management, and management need to know the source of short-term loans, so that the short-term finance needed, we will understand the availability of the cost. Current liability management, that means current liability management consists of minimizing our obligation and payment for short-term debt, accrued liability, and accounts payable. It consists of short-term debt management, accrued liability management, and accounts payable management is the current liability. So here, planning and control of inventories. The inventory control is the regulating or maximizing company's warehouse inventory. Inventory control involve warehouse management. It includes barcode scanner, record keeping, product details, and etc. And also we have seen our management accounting or my management information or cost accounting, and there are a lot of techniques for inventory control, also EOQ, etc. And also the inventory management, also ABC, and that means the price of inventories, which pair of price inventory is high, but item is nominal is in the number A. That means is the with category is the all inventories A, B, C, and also you can say that always better control A, B, C. And that means if we control A and B, so nothing need not to control C, because C is a huge amount. So explain benefit of the importance inventory control. Here, if we control inventory, and benefit is that protects from fluctuation of demand. It's help in giving better service to customer. It's aids to continuing production operation, reduce the risks of loss, minimize the administrative workload, to rise to protect fluctuation in output, makes effective use of working capital, and also check loss material due to pilferage, facilitate cost accounting activity, and also avoid duplicated order of stock, and overall help to the management for decision making. And that type of control should be aligned with the organizational policy. The goal of inventory control procedure is to maximize profit with minimum inventory investment without impacting customer satisfaction level. So giving the pure service or satisfaction to the customer, you can control the inventory. So planning control of a stock, this is stock different way. This is stock, that means is not the inventory, is the share also. So the stock, that means it's called capital stock, that means share. Corporation constitute the equity stack of the owners. So there are two main types of stock we know. Preference, that means there are two types of main share, that means common share and preference share. So have to manage and control it. And if equity, that means we can invest in the capital market and go for public, and capital market investment takes place through the bond market and stock market, etc. Here, associated working capital management, there are a few ratios we can use for working capital management. That means stock turnover ratio generally gives the result is times. So cost of goods sold divided by average stock, then we will get a stock turnover ratio. Is result is times. And also a stock turnover ratio, if gives the days, then what we have to do, average stock divided by, or also you can say inventory turnover ratio. So average inventory divided by cost of goods sold multiplied by 360 days, then we'll get inventory turnover ratio. Then receivable turnover ratio is also give the result times, that means net credit sale divided by average accounts receivable. And also average receivable period result will give us the days, the average accounts receivable divided by net credit sale multiplied by 360. And payable turnover ratio, we can calculate net credit purchase divided by average accounts receivable, and average payable period also we can calculate average accounts receivable divided by net credit sale multiplied by 360 days. So this way our working capital management help that type of ratio. Sometimes we can see in our question also. So here the problem here is the calculation of cost benefit, total cash flow cycle in time, and another one effective rate of line of credit, and D, cost of financing inventory. Cases are separate, each and every case is unique. So here 4 cases. Look here. So 5, another one, cost of commercial paper. So all 5s are here. Answer is all 5 here. So I think you try it with after seeing the question. And here Another question,